This webinar discusses the continued nervousness in markets due to Europe's sovereign debt crisis. Number 1. The Asian markets declined on nervousness about European debt crisis. The key driver of decline in stock markets has been the rising cost and risk of the Italian bond. Number 2. The European yields soared, reflecting greater risks to the investors. Any bailout package can provide interim solutions only. In the long haul, the European economies need to put in place solid fiscal management structures. This is the most viable path to discourage recurrence of debt crisis. The hardest challenge is to align political will to painful economic realities. It is not easy to implement fiscal restructuring without some sacrifices and perhaps political fallout. Number 3. Italy's 10-year yield rose above the psychological benchmark of 7%. This position on a similar note had triggered Greek debt crisis and it had to seek bailout package from the European Central Bank. Number 4. In China, the stocks declined on speculation that a tight monetary policy is dampening growth. Worries about the European debt crisis and recent decline of euro have added to the Chinese economic woes. More importantly, the outlook for Chinese export to Europe is not positive. Overall, the market sentiment is underpinned by uncertainty and volatility.